Hello, 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 everyone. Welcome. Happy Friday to everyone. Hope all is well with you. Safie Russell here, founder and CEO of SDR Consulting, Inc. I want to thank you for joining us on Business Basics Friday, based in New York. And today it's going to be 93. It feels like a hot yoga studio outside. That's all I can equate it to, but I'm not going to complain. We only get 2 months of summer here, so feel free to share if you're here with us live on Facebook, where you're joining us from, what the temperature's like. It's July 2022. We'd love to hear from you. And so a little background about myself. I've been in the industry 20 years, and I'm a CPA and enrolled agent, and also have a master's in taxation. SDR Consulting, Inc. is a virtual firm based in New York, but we service clients all over. And Business Basics Friday is a weekly session catered to providing valuable information to business owners. We have a variety of guest speakers that come in and help share information and educate you on the many areas of your business that you may need to manage. Just as far as disclosure, this is strictly for educational purposes and information. There's no client relationship established and no legal advice. And as far as the work that we do, we work with mostly business owners, especially those in the mental health profession with their private practices, to help reduce their concerns regarding tax and accounting so they can focus on their own well-being. So today's session, if you do have questions, I recommend you go ahead and post them in the chat if you're here on Clubhouse, or in the comments if you're here on Facebook Live, and we will go over them at the end. And so it's my pleasure to introduce our guest speaker today. Frank Mastronuzzi, founder of Punch Accounting, is joining us today, and I want to thank him for the time he took out to share with us regarding the topic of how to budget for an extended runway during this economic downturn. So Frank, the floor is yours. Take it away, and thanks again.
Hi, Safie. Thank you so much. Hello, everyone. As Safie just mentioned, I'm Frank Mastronuzzi. I'm founding partner of Punch Financial. We're a San Francisco and LA-based accounting and CFO services firm. Like Safie, our focus is really on technology startups and high growth companies. So majority of our clients are venture-backed startups, but also throughout the years, we've been in business 8+ years now. Throughout the years, we've added extra categories of clients. Our second category, services firms. So we have, TikTok influencer agencies, we have PR firms, we have customer acquisition firms, all kind of service agencies that service the high growth companies. And then we also specialize in content and direct to consumer e-commerce. So we have YouTubers, TikTokers, we have a lot of direct-to-consumer e-commerce companies, and we're virtual also. So while we're based in San Francisco and LA, we have clients not only throughout the US, but we also have some international clients that want to come to the US to raise capital and launch their service or product in the US. Right now, the hot topics, Saf and I were talking, one of the hot topics that we keep getting from a lot of our clients over and over is, hey, we keep hearing in the news that there's a recession coming, there's a downturn coming. What can we do? And what the advice we give to all and have given to all our clients is, it's not a bad time to tighten the belt, take a look at your budget. It's always a good exercise to do throughout the course of a year, anyways. But we tend to look at budgets with our clients on a quarterly basis and adjust. But given that it's a topic that's keeping folks up at night, we really wanted to address this and talk about it so that people have a better idea. And the number one question we get is, where can we cut? Where can we adjust our budget without affecting, the business as much, or downsizing on staff or the likes? So with that said, I'll do a quick presentation here. Run through kind of high topics, and as Safie mentioned, if you have any questions, feel free to add them into the chat windows, and at the end, Safie and I will have a dialogue and address your questions directly. So real fast, we talk about who is Punch Financial. Like I mentioned, we definitely are re-envisioning how accounting firms work. We are just in time, so we bring in expertise as you need it. So while you'll have a full staff assigned to you, and when you need a CFO, they're available and they know your business. You're not paying for that until you actually consume or use those services. We're really growth focused. So folks that really want to get from point A to point B, our goal is how do we get from point A to point B, whether that's an exit, M&A, sale, IPO, whatever that is. And I like to say our team scales as you scale. So as you grow, our team grows with you. And so we really truly look at it as a partnership with all of our clients. So we get there, kind of give you best practices and start growing with you, and focused on that growth and growing profitably and focused on what the end goal is. And like I said, we definitely feel like we're part of the team. We've been involved, and so we feel like all of our clients we're part of the family, and we've stayed on board and stayed friends with a lot of the folks that after they've exited and gone on to second or third or even nonprofits that they've started. Real fast, accounting services, growth fund strategy, CFO advisory, coaching, support, budget, and cash burn, which is what our focus is right now, and scalable financial infrastructure. Important to build infrastructure that will scale with you so you don't have to switch accounting systems midstream while you're growing. Real fast, a bunch of our clients here, like you said, like I mentioned, and they're all over the board. We're industry agnostic. We're just looking for teams and products and services that make sense, and that really have that one goal in mind, and that's growth. So again, number one question we get is how do we extend our runway? How do we extend our burn? Debt financing, lines of credits are being shortened. A lot of things we're seeing in the market as banks are even preparing for potential economic recession. So you're starting to see some of our clients' lines of credit be reduced. And so we're seeing the signs that everyone's kind of preparing or bracing for impact. And so the number one question we get is how do we persevere through this? Our general approach is to kind of figure out where your cash is and what your cash position is, right? So it's not just the cash in the bank, which a lot of our clients forget. It's also, your AR that's due to you, less some discount because some folks may not pay during this downturn. Also, reducing what you owe, AP, credit cards, anything like that. And that gives you an adjusted cash position. And then we start there that's your cash position. So then we're looking at, hey, how much cash do you have? How much runway do you have? Are you looking to try to get through next year? 2023 is what we've been focused on, just to be kind of safe. With all indications, no one's going to be right on this, but everyone's guessing different timeframes. And there's definitely information's not pointing in one direction for sure. There's, employment is strong. So there's, interest rates are going up, loans, homes are going, mortgages are going down. So there's been a lot of indications. So we're trying to just use the runway of, December 2023, just as a ballpark for most folks. And we just using a case study here, right? So we're just showing as an example, one of our clients, we're looking at their cash position, their AR, like we just mentioned, getting an idea. In this case, our client here had about 19 months if they didn't make any adjustments of runway. So they need 19 months of runway, which is about, $118,000 of burn each month. Now we're looking at startups. So this is very focused on burn. And not profitability, but you can apply this to profitable companies and growth service firms like yours. But the focus here is just kind of runway and how to get a startup to that next fundraise. So here they have, the burn needs to be about 118. Their burn was 250. So we needed to get that delta of about $130,000 a month. And so the first question was, how do we accomplish that, right? So we're going to walk you through real fast, kind of different areas that we focus on, and then kind of just give you tips and tricks of things that you may not have thought of, and the approach is important. So what we tend to do is touch payroll and customer acquisition last, because obviously downsizing staff is the last thing most companies want to do, and they don't want to affect their sales and customer acquisition, so the marketing spend. So we focus on what can we reduce first, then switch it over to those last items to kind of make up the last remaining delta. Most people just gloss over COGS because they don't think there's a way to reduce their cost of goods sold. We say there always is. One big line item is merchant fees. There are definitely processors out there that will negotiate with you, and even a slight reduction in a couple of points can mean a significant reduction in merchant fees. So, no offense to the Stripes and Squares out there, we love them, we work with them well, but at the early stage of smaller companies, they're not willing to negotiate. It's a one size fits all product, but there are some other merchant processors that will negotiate. You can start with your bank, but look out there because there's definitely, Fiserv and a couple others that are definitely being more aggressive in the marketplace and willing to negotiate. So they'll look at your merchant fees. They'll assess the costs and say, here's how we can do better. It's free of charge. You just have to share your merchant statements with them. But we found that has saved a lot of our clients a good amount of money and something that they weren't expecting. Also in COGS, we've seen a lot more automation on customer support versus having live staff, and even on some of the call services, right? You're seeing like Good Call that has AI that you can script. So there's ways to reduce some manual processes in COGS on the customer support side, and general administrative costs. And so those are two areas that we like to focus in on COGS. Another area that we like to focus on is cost reduction is Sas subscriptions. People tend to feel like whatever Sas subscriptions like Slack, Twilio, Grammarly, whatever they have, they can't reduce Google Workspaces. When we start asking and even comparing their employee list to the subscription seats, there's a disconnect, right? There's people that weren't terminated when they quit. There's a lot of folks that aren't using the service, and you can tell from the SaaS, the service provider, that they haven't logged in for 90 days, 120 days. So then we reach out and say, hey, do you really need this? Can you share a seat, right? That's another thing. If you're only logging in once every 6 months, maybe you can share a login with a team, or just have one general login for the company that everyone shares and goes in there. And so we found that along with Google Workspaces tends to creep up. Once you shut them, emails down, you can port out all their data to someone else. We have one account typically in Google Workspaces for all the people that quit. So it's just residing in one account. And so that you're not paying to keep all those, retired accounts live or storage, you just put it to one. Another area we see, again, not everyone's in this, but AWS and web hosting, people just take that kind of for the Bible, whatever the costs are, but there's definitely ways to reduce the fees that you're paying, Amazon Web Services and all the others, Azure and so forth. You just have to ask. There's ways to put, storage into second and third tiers that you're not accessing that data. Again, if you're not accessing that data frequently, they can put it into secondary, third levels of response time, and therefore you're saving money. And there's always good ways to do that. If you go to them and say, hey, we need to reduce these fees, or else we're gonna have to shop around providers. Miraculously, all of these providers have found ways to reduce the fees. They just don't offer it up to you unless you're asking for it. And then recruiter fees, right? So, a lot right now with the market being as tough it is, folks are really using a lot of recruiters more than ever now. There's a way that you can work with them that's either going to defer the fees or eliminate, that retainer and pay for performance. So based on just hires. One of the things that we've been doing across the board is incentivizing our staff. So increasing the fees for referrals from your employees. So when you keep kind of putting it out there that you're increasing, people start paying attention and tend to always have one or two people that they can refer or post on their social media. We ask a lot of our employees, of our clients, to post, and it works really well. And the other we're finding that's definitely more effective is when the owners are reaching out directly on LinkedIn to these folks and trying to recruit them over themselves. It just gives the prospect that much more of an incentive, because they're like, hey, the owner or someone in management's really reaching out to us, to me. So they must see something that's exciting or interesting for for me to join the firm. And so it's been working really well for a lot of our clients. Again, ways to cut on payroll fees. There's a lot of hidden fees, especially in PEOs. Again, I'd go back to your account exec and ask them the way that you can reduce the fees. There's a lot of per head count on HR. I would ask them to reduce the fees. The fees range from $75 to $150. If you're not at the 75 range, I suggest you go back and ask if you're going to do that. A lot of our clients are switching off of PEO during the downturn as this renewal is coming up. It's coming up real soon. A lot of our clients are switching to, say Augusta or Rippling or something like that, and then finding an insurance broker to help them reduce those fees. You could always switch back, but it's pretty expensive, and it's hidden fees that get buried in the total expenses. And so when you really start digging into those, you find that there's ways that you can save on payroll. Travel, a lot of folks are not only reducing, you see in the news, a lot of companies like Google are putting hiring freezes, but what they're also not announcing is they're putting travel freezes in too. So they're really only allowing people to travel that require it or sales related. And so we're seeing a lot of also the use of miles and points that have been accumulating that people forget that they have. They're really starting to use those for their staff and their employees. Again, a good housekeeping way to try to save on travel and expenses. Marketing PR, what we're seeing across the board, this is not customer acquisition, it's just generic marketing PR that are not tied to sales. We're seeing as people started to pick up on conferences and starting to do live events again, in PR retainers, what we're seeing is a lot of that being paused or reduced. On the PR side, we're seeing a lot of people either trying to get out of their PR arrangements or pausing them for 6 months, saying, hey, we'll continue the contract, but we need a 6-month reprieve. So pause everything we're working on for 6 months. And PR firms tend to want to keep their clients, and they're willing to work with you most of the time if they want to stay a healthy relationship when things get better. So we really say that that's again a quick way that you can save or postpone on your burn for a bit. On the CapEx side, what we're seeing a lot of people that have policies where computers are bought every 2 years, or desks, what we're really seeing is folks really going to the secondary market or skipping the cycle, saying, hey, we're going to skip this next cycle, so your computer is not going to only be 2 years old. It's going to probably be 4 by the next time we buy a new one. So again, ways that you can reduce expenses. What I always see with our clients is when the first natural inclination always from a human being is no. The answer is no, we can't reduce that expense. But when you start asking questions and you really start pushing back, they finally kind of say, oh yeah, that we could live with that for a year or two, right? So that's not a problem. Rent, again, if for those that do still have offices, we're still seeing our clients go back and trying to figure ways to either sublet, talk to the landlord, reduce the parking spots if people aren't coming in to the office. Anything you can do on that spend by talking to them. Most folks are just afraid. They're willing, again, given everything that's happened, we find most landlords willing to negotiate or try to help out. If you've been a great client and a great rent, leasee. And so, that's one area that everyone always thinks they can't get anything, and then they're always surprised when they do. And again, a lot of our firms use us as the bad cop. So if you want to keep a good relationship, have your outsourced accountant, CFO, ask the questions. It can't hurt. And as my mom always says, you don't get if you don't ask. And so I think, that's another way that we focus on, of reduction for our clients. Utilities, again, another area. We're finding that simple programming, that there's thermostats and that haven't been programmed. If there aren't thermostats that can be programmed, I would spend the money to do that. Just changing the amount of time and hours that things are on, even lights, makes a huge difference. The client that we're showcasing here, saved about 40% when we did all these things, right? Making sure that someone's responsible for turning everything off when they leave. Again, making it not just, instead of saying the last person out the door, close the lights, everyone assumes that someone else is the last person. It's not them. And so what you say is, hey, John, when you leave every day, turn off everything. And if someone's there, they're gonna pop up and turn on the lights again in that area that they're in. Or you can then say, hey, Susie, when you leave, make sure you turn everything off. I didn't know you were here, type of thing. But what we found is that really does help a lot. Insurance expenses, again, we see that if you shop your policies around, we do that as a general rule of thumb. We don't just let the insurance broker come back, because there's definitely in the industry, they're going to creep up 10-15% each year anyways. When you shop out all the policies ahead of the renewal period, you're always going to find good price and in sometimes even better coverage, more bang for your buck. And so we always say this is a time to evaluate your policies, look at the risk to the company. You may be willing to take a little more risk right now, by lowering, or increasing some of your deductibles. Again, just for a year or two, ways to reduce expenses. You could always ratchet it back down and increase it. And one of the areas we kind of talk about is, if you do have a PEO, you don't need EPLI, employee practices liability insurance. We see that a lot where, it's redundant, right? If you have a PEO, you don't need EPLI, and that can save, a good $7,000 to $10,000 a year sometimes. Client gifts are always a tricky one because we try to not scale those back, because if you scale those back around the holidays, people tend to feel like the company's in bad shape, and then they're worried about your longevity. So we just say, if you've been giving client gifts, continue to do them. You may change it for a year, right? Reduce the costs, but don't eliminate it. What we've seen is that tends to sometimes cause some issues on the client side, because they feel like it's a signal that that the company is not doing well or faring well. Kind of those are just our first pass of all the expenses that we see, and then like we said, what we then focus on is customer acquisition, and then payroll and staffing, because those are the two most painful areas to cut on. Again, when you start really digging in and looking at customer acquisition expenses, there's ways that you can save money. And that's with you're kind of looking at Google and Facebook and all the things that you're spending money on. What we found is just even if it's structured well and properly, by turning off some of the campaigns within that are performing underneath your averages, again, just for a couple months to kind of see what happens. Surprisingly, traffic may dip, but your quality still kind of stays the same, or the quality of lead stays the same. Again, don't take it for gospel that what you're doing is correct and it's fine, it's been working. Really dig in and see what areas you can reduce on. And that's getting in with your agency sometimes and saying, we need to reduce the spend. Where do you recommend? Again, putting the requirement down, because they obviously are all incentivized, Google, your agency, to get you to spend more. But when you're saying, hey, I need to reduce the spend to, $1,000 more, where do we turn things down? I wouldn't turn down on the keywords that are performing. I would really just cut off on the other, shut down those other keywords on the long tail that you're getting clicks on that may not be resulting in a lead, a contact, or something like that. And so when you just start turning off certain keywords that don't have conversions tied to them, our clients are always shocked at how well this works and how much they've reduced their spend. And you can reallocate some of that lower production, items. So the ones we just turned off, you can still reallocate that spend to the higher, the words that you're bidding on higher, that then convert, right? So again, we're not saying that you have to completely eliminate them, but just to reshuffle. This is a good time to leave all stones, no stone unturned, is what we say. When someone's like, we can't touch that area, like we look through, we still say, why not? Let's dig in. And then if there's reasons why they can't, then we're fine with that. But we still want to go through the process, because when there's areas that we found that whenever there's areas that they say they can't touch, there's always ways that when we start asking, they're like, oh, we didn't think about that, or yes, we can. So push yourself on those areas that you may not. Back to the least favorite area, you're seeing downsizes, and reductions in force across the board. We always feel like this is a difficult task, but if it's needed, then you have to, sometimes sacrifice a few folks to save the ship. I always like to reference, there's a movie called U-571 with Matthew McConaughey. If you haven't seen it, it's a great movie. Watch it. It's also a great lesson learned for entrepreneurs. Sometimes you have to sacrifice a few folks to save the whole ship. And so in that case, we're saying the kind of same thing. If you're going to do it, though, we say try to do it in one pass. Again, what you don't want is a series of reductions, because what happens is then you start to lose some of the good people, because then they don't know how far and how many times the cut's going to happen. So they're not going to wait around. So we say if you do it fast and do it once, then it's like pulling the Band-Aid off and then get back to business like nothing happened. Then that's the best approach. The thing that we always say is don't forget that salaries includes employer payroll, taxes, and benefits. So your reduction in salaries will also be a reduction in benefits and payroll taxes, about 20 to 27%. And so you don't necessarily, you have to kind of figure out how many salaries you need to reduce, or how much in salary you need to reduce to save, and plus the 20 to 27%. And then we say go through each of the departments and kind of look at where you can eliminate. I always try to bring everyone involved so that it's a team collaborative effort. If there's ways, so that it's again conscientious and it's very sensitive. So we're very sensitive to the process, because we don't necessarily work with these folks on a day-to-day basis. So it's always like for us, we kind of take a step back and say, since you know these folks and you work with them on a daily basis, your insights more beneficial. We can kind of just give you benchmarks and targets. You have to kind of figure out what where the reductions can happen. And sometimes what we've seen that was worked also is a salary reduction across the board, saying, hey, we're all going to take a reduction to get through this period until our next raise, or until the company's in better position. And if you do have options and grants, what we see is some people will increase the option grants and reduce the salary. So they don't feel like they're losing, because they're still getting some options in lieu of the salary. Again, this does not apply to everyone, but If you feel like, maybe you can make it up with bonuses down the road, we say we'll reevaluate it. We try to give them some sort of hope, like we will try to make it up when we can and when we're in the position to, but there's no guarantees. And then on the benefit side, what we've seen is just changing the baseline health insurance, right? What the base policy is, what the company coverage is. If it's 100%, we've seen people reduce to like, hey, we're now going to cover 75, the employees covering 25. These are all small changes that can save big dollars across the board. Another area we see is changing your match in 401k from automatic match to profit sharing. So you have the choice at the end of the year if you're going to do a profit sharing match in your 401k instead of the automatic 3% that most people do. This tends to work because if the company's doing well, then they get a match in the 401k at year end. And so it is a good way, and it gives you the ability to say yes or no, depending on how the company's doing. So we've seen that one change in the 401k, again, you can make that change during the renewal period, and you can only make that change once, but it's something that we see that works well in growing companies. And then when you get to a level where everything's great and going well, you could always switch back to the 3%, automatic match and stick with it. We've seen eliminating some extra benefits like life insurance or FSA or something like that. Commuter benefits, right? Because a lot of people aren't commuting now. So there's a lot of other benefits extraneous outside of the health, vision, and dental that we've seen a lot of our clients turn off and then turn back on in the next year on the renewal. So I think that covers the benefit side. So here's a quick summary of our Runway tips. We do always say do them collectively as a management team or as a company, because when people feel like they're part of the process, then they understand, and it doesn't just feel like you're cutting. They understand the goal. They understand they have inputs into what's being cut. So we tend to say do it as a management team, or do it as if it's a small company, do it with some folks that are involved, so they're involved in the process and understand what's happening. It's less of a shock when they're in knowing that it's coming, that you're looking at a reduction in budget, and that over the next 2 to 3 months, there's going to be a reduction. And so they start to brace and prepare themselves mentally. I always say send it out ahead of time so each department can come prepared with questions and areas that they think that they can reduce. Again, the more that they feel in control of the process, the more buy-in you're going to get and the easier the process is going to go. We also say really important is putting into practice monthly budget versus actual. So looking budget versus actual reporting. QuickBooks has it as a baseline. Most people just don't key in the budget. If you put in a budget and look at the variances on a monthly basis, you can see where you're going wrong and make adjustments as you go. Again, that's also a good key point. This isn't set it and forget it. You're gonna keep tweaking as you go. So using this budget versus actual reporting is important because you can see where you may be saving more, so that you can then also dial back up customer acquisition. You want to be watching it on a regular basis. And like I said, in the next point, review it with your senior management team and adjust each month, right? It's not a set it and forget it type of thing. It's a constant review and figuring out where to go. We also say when you do this, add a cushion in your budget that most folks don't have. Just a rainy day cushion, so that if there's any unexpected expenses, that's hard to say fast, that come up, that you have that cushion. It's not going to blow your budget out of the water, and that you're saving it there. And if it's not used, great, then you're ahead on your budget versus actual reporting. And so it works out well for most people. Just also a peace of mind for the business owners and the management team. If they have this, but they know that they have a little bit of a cushion in the budget, and it's not do or die if something goes wrong. And again, this approach does not take into consideration that if actually your sales or revenue increase, right? So you're using the baseline of what your expectations are. But if during this downturn, you manage to increase your revenue and sales, then your cushion and your profitability is going to be that much higher, and you're going to have additional runway and comfort in that area if you continue to grow your sales. So just again, real quick summary, it's a monthly process, not a set it and forget it. Adjustments will be needed to be made. So just because you do it once doesn't mean that it's going to be set in stone, and definitely use your budget versus actual reporting, and look at what the pluses and minuses are and why, and the sooner you can nip them in the bud, the better. It also is great when you start questioning expenses, because then not only do your employees realize that you're watching, but also your suppliers and your vendors. And so then they really take focus on kind of what's happening, on their billing to you, because they know you're watching. So with that said, here's my email address and phone number. If you have any questions that you want to discuss with us, feel free. Safi and the team will have this, so you can reach out to frank.m@punchfinancial.com, and we look forward to hearing from you guys.
Perfect. Thank you so much for sharing that valuable information, Frank. I know sometimes people don't want to hear the numbers and what it takes, but know your numbers, right? That's the summary. If you don't know your numbers, everything that Frank just shared with us, you won't even know where to start. So you want to definitely have your systems in place, have your bookkeeping in place as a starting point. Then you can have the actual to compare the budget and know where the money's going, and start looking at ROIs and all those percentages of KPI stuff, to know if it makes sense. And some of the key takeaways that I got from your presentation is not even just the like the client acquisition cost, right? That's a major factor, but are you as the business owner doing everything? And how does that impact, the money the time you could be spending in client acquisition versus in your administrative tasks and your billing, and if you have a private practice, you're trying to do the onboarding and the billing and and the bookkeeping and and all that time spent in those spaces as opposed to client acquisition. Those are things to look at as well, because you could be minimizing the amount of money you can bring in by doing those tasks that are just costing you. Right? What are your thoughts on that, Frank?
Yeah, no, Sabi, that's great. One of the clients that I featured indirectly through some of the images there, he was heavily involved in the day-to-day operations and too involved. And then we came on board. He's an event planner, right? And so we're like, you need to be spending at least 50% of your time on sales, because what people are buying is your vision. And we're like, you got to get out of the day-to-day. You got to trust us and the team and hire, because, and it's true, he was doing under $1 million in revenue. And, even now through COVID, he's over 10 million in revenue, because he's now spending 75% of his time pitching and focused on sales. And so all the other, all the issues that he had at under $1 million really disappeared, because company grew. And it seems counterproductive to your point, because you're like, I could be saving that money by doing it myself. But what most business owners don't realize, Effie, is you're the visionary, you're the business, right? And so people want to buy from you. And if they're not hearing from you because you're the one behind the scenes doing all the other extra work, then you're not going to have sales, right? So your point is very well taken. We've seen it over and over. And again, it's counterintuitive. We're not, and Safi and I are both not saying, you still have to be very involved in the accounting and business and know your numbers. You can't just walk away from it all, but you need to step in and do it from a higher level review the budget versus variance analysis, understand your numbers, but again, focus on customer acquisition and sales, because no one's going to sell the company better, your services or your business better than you, because you're the ambassador. It's your business. You're the visionary, right? So it's a very good point.
That's powerful that you said at least 50%, should be dedicated to the sales, because most entrepreneurs, even myself, that was not the case. 50% of your time is, if you're in the business, is probably, towards actually doing the work. And then, let's say, for example, with a business like taxes where it's seasonal. And then so January to April, what have you, couple months, people on extension, et cetera. What about in between, right? If the sales wasn't being concentrated all that time, here comes May and you're like, whoa, where's the new clientele? And there's the cash flow issues. And then that kind of rolls into the line of credits and the debt and those things. So that that was a great tip, you know, and I'm sure it could vary per industry, but if you're not concentrating on sales monthly, every week, every day, for a portion of the time that you're putting into your business, there's no future growth, right? Because like you said, no one else is doing it, right? Social media is great, good for presence, but social media is not going to sell your business by itself. And I think a lot of business owners tend to rely on that, or they rely on, you know, marketing companies, which is, you know, some I'm sure are great, but like you said, you're the best person to sell your vision.
Yeah.
Yeah.
Well, and again, even we're eating our own dog food, right? The minute I shifted from doing all the day-to-day operational stuff and relying on the team to do it, and really focusing myself on doing stuff like this, right? And getting out there and really getting the message out about the firm, and showcasing our expertise. Then, you know, those take years, the pipelines take years to build up. And, you know, and as I say, you can only fill the pipeline so much. When it falls out, you can't necessarily always control when things are going to convert. But for us, it's been years of building and building, where now, you know, it's really starting, you know, the fruits of our labor are starting to come, and we're growing fast now. And we're growing controlled, which is also another big lesson. You know, what most people don't realize, a lot of companies fail because they grow too fast, and it's not, you know, controlled growth, and it's not quality. You know, we're focused heavily on quality control. So we're growing, you know, very conscientiously. That's the other thing. You know, what's the keeping your presence of what does your brand want to represent? Because we rather say no now, and then instead of having a bad, unhappy client on the back end that's going to talk about how bad the experience was, right? And so we'd rather kind of turn down a client versus do a bad job, right? If we don't have the bandwidth, because it's really hard to change the brand image once it's out there and people are out there complaining about you. It's really, really hard to change that narrative.
Definitely. And it's, you know, some places may focus on quantity and we focus on quality, you know, and sometimes you do have to say no. And I know that can be tough for businesses when they're, you know, struggling or just getting their feet wet, you know, just get started in their industry. But saying no, you know, allows other opportunities that may be a better fit. And definitely, you know, the bandwidth, like you mentioned, and the controlled growth, and, you know, everyone wants to scale, but do you have the support, you know, to scale, you know,
Well, and
if
we
it goes
do, and
fast.
Safie, I'm sure you do the same, but we're very much the Miracle on 34th Street approach. Like, hey, we don't have it, but if you go up the street, like Santa Claus was sending people and Macy's, whatever the store was, like, what the hell are you doing at first? But then it was good, positive will. Like, hey, they remember that we still help them out by recommending a couple of folks. And we're like, hey, stay in touch. We check in with them, you know, down the road, maybe it's a better fit, or we have more folks. But, you know, our goal is to pay it forward. You know, entrepreneurs in general like to help each other out and pay it forward. We're a rare breed. And so we have to kind of help each other out. And that's the approach we take.
Absolutely. Totally about being transparent, you know, same thing we do here. If it's something that we know we don't have the capacity or the, mainly the capacity, or if it's something that's out of our, you know, specializations, and I'm gonna, you know, if there's someone I know, great, I'll make an introduction, not a challenge, because it comes back, you know, definitely comes back. So any questions, feel free to post them in the chat here or comments. I know this was very thorough, so I'm sure everyone got everything you said. We'll definitely wrap up here in a minute. One other thing I wanted to mention, as you went over the expenses, is the, you know, ad spend, you know, and I know different companies may have different ways, whether they're paying recruiters, whether they're doing social media ads or anything like that, is to really look at that return you are getting, how many new clients you brought in the door from those efforts. And so those are some of the ratios that Frank mentioned. If you don't know where the money, you know, where your money's going, it's hard to do that. But first, you want to get a handle on that. But if you're working with someone month after month, year after year, and it's just what you do, doesn't necessarily mean it's the right thing for your business, right? So make sure to definitely take heed to the client acquisition cost, the ad spend, the marketing dollars, and that you're actually getting a return and it's effective. And then the technology, definitely streamlining your systems. Finding out what can effectively accomplish the same goal, so that maybe even if you don't get rid of that staff person, maybe there's a better position for them that they could do that would bring in revenue as opposed to something administrative that technology could resolve. So, with AI and all the different tools out there, outweigh the cost of that technology versus that staff person, and what could they be doing that may be a better fit, a better quality of service for your business. So definitely, Frank, I think anything else you want to add at the end, that'd be perfect. But I think this is very thorough. I'm looking forward to, the replays and things that'll come through, because I'm sure people are going to want to replay, rewind, take notes. I'm going to watch it again, as well, because it was great information. So if anyone joined us here lately, I'm just going to go ahead and close out with sharing my information. And Frank, I'm gonna have you share your information as well, just in case people are listening and didn't see the visual. So this was Business Basics Friday, and we had Frank Mastronuzzi, okay, coming in to discuss, some tips on having your budget prepared for the upcoming, pending recession, and what you can do to be prepared for that. And it was great information. Definitely catch it on the replay and share it if you weren't here live for the whole session. So I'm founder and CEO of SDR Consulting Inc. I'm Safie Russell, and we focus on working with business owners, especially those in the mental health profession, helping them with their tax and accounting needs, as well as business consulting. And we can be found online at sdrconsultinginc.com, on social media at SDR Consulting, and by phone at 516-255-6603. And Frank, if you can take away your information, that'd be perfect.
Sure. Again, Punch Financial. We're at our website is www.punchfinancial.com. Our office line is 510-345-2799. You can find us on social media at Punch Financial on all the platforms. And if you have any information or requests, you can do an email at info@punchfinancial.com, and you'll get a response from our team pretty quickly. And thank you so much, Safie, for having us. We really appreciated it and enjoyed it.
Thank you. You're welcome, Frank, and it was a pleasure anytime. Hopefully we'll do this again and work together more in the future. And I want to thank everybody for joining us today for Business Basics Friday. We will not be here next Friday, going to take some time with the family this summer, but we will be back the following Friday. So feel free to join us at 12 o'clock Eastern, share with a friend, and stay tuned for the upcoming guest speaker. You can also find these audio versions of the sessions on our podcasts, SDR Business Basics, and that can be found on all the major streaming platforms and Spreaker.com. All right, everyone have a great weekend. Stay safe, and Frank, have a good day.
Take care. Bye.
Thanks. Bye-bye.